we started a YouTube channel explaining how Bitcoin works, how crypto works, how decentralized finance and blockchain work, not telling people they should buy it, not pushing it. Here's how it works. So come to today where now we teach others about crypto, about digital assets. We teach financial advisors how to make it a safe part of their practice. And that's where we are today. So a few little housekeeping notes. One is at the end of this, we will send out a link to a form that you can fill out, and that's how you're going to get your continuing education. Number two, of course, we are not giving any investment advice, tax advice, anything like that. We're just explaining. Number three, and maybe the most important, is we make it very clear in our courses. We make it very clear when we do this. We are not trying to tell you that you should go get your clients involved in Bitcoin or cryptocurrency. We don't even tell clients that they should get involved. We're here to educate so that when your clients have questions, or if it's something that you might want to get into with clients that have already purchased cryptocurrency, that we are helping you to understand it so that you can have the effective conversations with them to make it a part of your practice, to have those conversations so that you can help make it a safe part of their portfolio and understand it. And so when you have those conversations, when you either say, yes, you should, or no, you shouldn't, or here's how we do it, it comes from the perspective of education and understanding, and not from the perspective of an article that we read that said that it's bad, or the fact that someone said it's only used for criminal activity. So now we come from this perspective of education and understanding. With that, I'll also say that Ron, my partner, Steve Larson, is also in here. He's a partner of us to help with the continuing education and with our certified digital asset advisor course. They can potentially be answering some questions in the chat, and Ron can stop me here and there if I get going too fast or there's some question that we need answered. So everyone good? Good. We're going to go on. Now, part of what we have to do so that everyone can effectively understand what Bitcoin is and what digital assets are is go back to the tech and go back to why this was even created. And I know we do this and get very basic and we get a little bit techie, but the purpose is so that when we roll forward, you understand what some of the issues are, and you understand how to evaluate things like custodians, and you understand how to evaluate some of the funds and the trusts and the regulation and the articles and the news that we're reading. Obviously, it's been in the news so much recently, and we want you to be able to understand what's going on. But to do that, you really have to roll back a little bit and understand what was going on and where the technology came from. So I apologize for some of the techie speak. We'll try not to make it too techie. So first we'll go back to the origins of the original cryptocurrency and the one everyone knows about, the OG, the Mac Daddy Bitcoin. Okay, Bitcoin was started in 2008. There was a white paper in 2008 by someone named Satoshi Nakamoto. No one knows who Satoshi Nakamoto is. It is most likely a group of people that got together and created this white paper and created this code. And the whole idea of Bitcoin, what we were trying to do was take out some of the fees and the friction that are inherent in the current financial system. And remember, 2008 financial crisis caused mainly by banks over leveraging on mortgages. That's what caused the banking crisis and the financial crisis. This is where that was born out of. And here was the idea. Here's what they're trying to solve. And I go through this a lot. You have two people, Adam and Ron. Okay, if Ron gives some sort of goods to Adam, and Adam writes Ron a check, keep in mind, maybe this is still in the days of checks as we start, right? If Adam writes Ron a check, there has to be some level of trust here, okay? Ron has to trust that when I write and sign my name and put a number on that check, that it's good and give me the goods for it. Now, Ron goes and deposits that check in his bank, right? Bank of America, we'll call it. Okay, Bank of America says, whoa, Ron, we don't believe that just because this dude Adam that you know signed a check, that there's actually $100 there. We're going to go check with Adam's bank called Chase and see if Adam actually has the money. Chase says, yes, Adam did have the money, but now he doesn't. We're going to send it over to you. Okay, so this $100 goes from Chase to Bank of America. Bank of America says, okay, this $100 came from Adam. It goes into Ron's account. Here we go. Now Ron has $100, but it had to go through this whole system. This system creates a bunch of fees and a bunch of friction. The friction is, of course, this only happens certain hours of the day, certain days of the week, and these banks have these pipes that they've created that effectively, create this power that they have. They have the power over moving money. Now, keep in mind also that this $100, this dollar sign, is outsourced to the U.S. government, right? The U.S. government essentially decides the value of the dollar based on the fact that they can print more dollars or take more dollars out of circulation. Again, this is very theoretical. We're not here to get into any sort of political argument about this. This is what the framers of Bitcoin were looking at. And what they were seeing was, here's a bunch of friction here. Here are places where banks can charge fees. And it's not just banks, it's insurance companies, it's any company like that that has developed some sort of moat around themselves from a tech perspective, from a plumbing perspective, that allows them to charge extra fees or create more friction and thereby giving themselves more power. And what the framers of Bitcoin thought was, they have taken this trust, we've outsourced this trust and this ability to move money, we've outsourced this trust and this ability to determine the value of money to the government, and they have abused that trust, and we don't like it. And is there a way that we can change it? And what they came up with was Bitcoin. So, any questions thus far? Because I don't want to go too fast and too far until we understand some of the basics of why this was even created. So, we will keep moving forward. So here's what they came up with. They said, look, how can we take out the idea of moving money from one person to another out of the hands of the bank and maybe let others do it? What can we do? Okay, so let's figure out what they came up with. So now you have Adam and Ron, and you guys are just gonna have to bear with me for a moment as we get to this, but it will all make sense in a moment. So they had to figure out a way to get money, which I will denote with dollar signs for now, but will eventually be Bitcoin. They had to figure out a way to get money from Adam to Ron without going through a bank. How are we going to do that? We have to process this transaction. Okay, well, let's take this mythical money thing called Bitcoin and figure out that Adam is going to send Ron 1 Bitcoin. Okay, how is Adam going to do that? How are we going to get 1 Bitcoin from Adam to Ron? Well, what if, let's just say, there are all these computers that we can connect. What if individuals were willing to help process this transaction instead of banks doing it? Would they do it? And the answer was yes. So they put out this code. So the Bitcoin is essentially computer code that all these computers connected to, okay, not, this is important, via some sort of centralized server, but the fact that all these computers downloaded this software means that they are now connected. This is what's called decentralized or distributed. Okay, it's not based on a certain server. They all write the code, they all read the code and run this code, and they're all connected. And by doing that, they all agree that Adam sent Ron 1 Bitcoin. This is really important. It's the equivalent of all 100 and some of us that are in this virtual room having a spreadsheet. And the spreadsheet keeps track of the fact that Adam had a Bitcoin. And when I say I sent it to Ron, we all take out our spreadsheet and we all say Adam minus 1 Bitcoin, Ron plus 1 Bitcoin. Everyone agrees. Yes, yes, yes. Everyone around the room agrees, checks it. Now we're keeping track of the fact that Ron now has 1 Bitcoin. Now Ron can go send that to Margarita if he wants to. But he couldn't do it until he had it, and we all agreed on that in the spreadsheet. That is what's called consensus. We have reached consensus. Now, this is another important piece. If one of these people, if one of us in the room says, I don't agree with that, and by the way, I have 100 Bitcoin, we all look at our spreadsheets and go, no, you don't. We don't agree with you. The code says all of us have to agree. Since we don't agree with you, then no, you didn't have that Bitcoin to start with. Therefore, you can't go send it anymore. So that was what the framers of Bitcoin were trying to get to. Can we create a system where different people can connect to this code and process transactions that banks usually process? And the answer is yes, we can. So now, I hope I'm not going too fast with this. Now we get into just a slight bit of the technicals, and the technicals are important because as we keep going further, and not necessarily in this talk, but as you keep going further and as you read some things and hear some of these words in media or some of the things you read, you'll understand where some of these terms come from. And it makes it really important as you're trying to help clients and you're trying to understand what's going on. So I'm going to give you very, very briefly a little bit about how Bitcoin actually works. And part of it is because I'm a little geeky and I find it really interesting. Okay, so this goes back to the idea of cryptography. This is called a cryptocurrency for a reason, and we take the idea of cryptography. And this, yes, is there a question? No, okay. So we take the science of cryptography, the science of essentially keeping secrets, and code that was written to keep secrets, in, especially in government terms, in banking terms, in financial terms, and this is what we used. Okay, and one of the most important tools we used is called hashing algorithms. And a hashing algorithm is very important, and eventually we can send you links to try this out. But a hashing algorithm, and in this case we use one called SHA-256, which is called Secure Hashing Algorithm 256. Here's what SHA-256 does. Okay, you have this algorithm, you put data in this side, and this data can be any, it could be song lyrics, it could be a picture, it could be a conversation I have with you, or it can be a transaction that says Adam sends Ron 1 Bitcoin. It goes in this box here. It gets hashed, it goes through this algorithm, and you come out with what's called a hash. And a hash is 64 digit hexadecimal number. That means it has letters and numbers in some seemingly random order. Okay, the hashing is extremely important when it comes to Bitcoin and cryptocurrency. So data goes in one side, it comes out the other side as a hash. Now here's something really important. It cannot go backwards. You cannot look at a hash and figure out what the data was that went into it ever, virtually ever. I say virtually, it's a 1 in some sort of quintillion chance. You could run this every second for the rest of eternity and you would never get it. Okay, so a hash, going through the hashing algorithm, you cannot go backwards, you can only go forwards. The other interesting point about hashing is, if I put data in here that says I am Adam, for instance, we will get one version of the hash. If I put I am Adam exclamation mark, the hash will look completely different. It will not even be relatively close. It won't be the same hash with an exclamation mark at the end, nothing like that. It will be completely different. This is also extremely important when it comes to Bitcoin and when it comes to crypto. So I hope this makes sense so far. Again, I apologize for the highly technical talk, but it's really important in understanding cryptocurrency, where it comes from. So I hope we're all good here. Ron, any questions so far?
I do not see any.
Seeing none, good. I hope everyone's still awake.
Hey, real quick on the hashing algorithm, it's important to know that any change in the data, so that's adding a space, taking away, changing the capitalized letter, any change in it changes the hash completely.
Exactly. Yes, it's based on not just the letters and numbers, but spaces, punctuation, caps, everything like that. So here's how Bitcoin started to work. Here's how they got around this, some of these problems that you have in the financial system, some of the inefficiencies.
Yes,
if you submit the same data over, you get the exact same hash. Okay, which is actually very important. If you submit the same data over again, you get the same hash. That comes in handy when we start talking about public and private keys. It's the same data, same hash is what you actually use to unencrypt things. It's actually what you use to say, I sent this data, and someone else can go, yes, you are the one who sent it to me. I know because the hash was the same both times. You are definitely the person who sent it to me. So that's actually a really important question. So what happens is Adam sent, again, we'll go with Adam and Ron because I see Ron a lot. I send 1 Bitcoin to Ron. This is a transaction. So all these people now, will say this, are enacting some sort of transaction like this, sending 1 Bitcoin or however many Bitcoin to and from each other. This is a transaction. So all these transactions, we'll call them transaction 1, transaction 2, transaction 3, come sit over here. Okay, they basically, people propose these transactions. Now what happens is these transactions get pulled over here. They get put into the secure hashing algorithm 256. All these transactions are in there. Adam sent Ron 1 Bitcoin. Margarita sent Ken 1 Bitcoin. Okay, all these transactions are in here. They go through secure hashing algorithm 256. To get technical, they choose something called a nonce, which is a number only used once, which is basically a random number. Okay, so this computer puts all these transactions into this code, puts in a nonce, gets hash 1. This is called a block. And you can see where I'm going with this. It's called a block. You get hash number 1, okay, from these transactions. Now, let's say you go with transaction 4, 5, and 6, sitting over here waiting to go. What happens is the computers take, again, secure hashing algorithm 256. You put in transactions 4, 5, and 6. You put in hash 1 as part of the data. You use your nonce, you run the hash, and you get hash 2. Hope that makes sense to everyone. It's actually pretty simple and pretty beautiful, right? Transactions go into the block, you create hash 1. You take new transactions plus hash 1, you get hash 2. Now, you can probably tell from this, the beauty of it is, since you can't go backwards, right? You can't figure out from hash 2 what any of this data was, then I can't know what this hash is and know exactly what was in here, okay? I can't go backwards. The other beauty of it is, you know for a fact that if anything changes in this block, in this data, right, then hash 1 will be different. This will change. If this changes at all and it goes in here, then this will be different, okay? And by that, what we do is we make this what's called immutable. This is one of the characteristics of a public blockchain. This is immutable. I can't go change anything in block 1 because it will change all the future blocks. And that cannot be done because we can't rewrite all these blocks because something changed. And that is really important because it means I can't go change transaction 1. I can't go back in the ledger. I can't, it's not like a spreadsheet. It's not like QuickBooks. I can't go change something and just have it blow through everything else easily. If I change something back here, every hash would change. And if you remember from where we started with the spreadsheet and consensus, if everyone doesn't agree, if all of us in this room don't pull out our spreadsheet and go, yeah, we agree on hash 1 or hash 2 and hash 3, then we can't go make a change all the way back here because all of us aren't going to agree on the blocks going forward. In this way, we create a chain of blocks that cannot be moved backwards, hence a block chain. We all good with that? Do we need to do that again? Any questions, Ron?
Cody, I think in just a minute when he goes over mining, he'll answer your question. If not, I'll answer it.
Okay. So I hope that makes a slight bit of sense here.
Adam, you can see, so the hash gives you the transaction. So it is very audible. It's probably more audible than anything.
Is there a question about transparency?
But he says you can't see transactions prior to the hash, correct? And you actually can see transactions in what they call a mempool, and that's really way down the rabbit hole.
Yes, so Bitcoin is without a doubt the most traceable asset ever. You can literally see every single transaction that's ever happened on the Bitcoin blockchain. You can go watch every single transaction. And if I gave you what's called my wallet address, which is the address where my Bitcoin is stored, where you can send me Bitcoin, you can see every transaction I have ever made on the Bitcoin blockchain. Okay, it is that transparent. So we have we have hashing. We're moving through the blocks. Now we're going to talk a little bit about where Bitcoin comes from, because I had to send Ron 1 Bitcoin, but we really have to talk about where it comes from, because that is what drives the value, right? It doesn't matter if I send him a Bitcoin if a Bitcoin isn't worth anything and we don't even know where it comes from. So if you remember, we had these decentralized nodes, right? These computers that are all connected to each other via the Bitcoin code. So what the framers of Bitcoin had to think of was, why are these people even going to connect their computers and try to process these transactions? This is stuff that a bank is supposed to do, and the bank gets paid pretty handsomely to do it. So why would these people all do it? We have to give them some sort of incentive. And so here's what they came up with. You're going to have all these transactions going on, and we need people to connect their computers and actually process them, to go through that exercise of putting data into a hashing algorithm, choosing a nonce, and spitting out a hash. We need them to do that. So what are we going to do? We're going to give them some incentive. So when they do that, so we have a block, they put the data in, they choose the nonce, and they spit out a hash. Now, what's going to happen is all these computers are going to try to grab this data, put it into the hashing algorithm, into this block, and spit out a hash. Now, the rule is this hash has to have a certain number of leading zeros. Okay, it's going to be a random number, of course, but if a certain number of leading zeros, whichever one of these computers was the one that processed this and spit out the certain number of leading zeros, that computer wins. That computer gets to process this block, is the winner that processed this block. And the winner gets Bitcoin. That is the incentive. This is called a block reward. So again, the framers, the creators of Bitcoin said, we need a way that people will connect their computers. They will take their processing power, their electricity, their time to connect to this network and start processing this transaction. In so doing, hopefully, well, one of them will get a certain number of leading zeros. The code says, the Bitcoin code says that whichever of these computers gets a certain number of leading zeros first is the one who processes the block. When it is processed, everyone else agrees this block was processed because they're following the code, they're following the rules. And the rules say this number of leading zeros, this particular computer processed that block, this computer gets Bitcoin as a reward.
Cody, that actually answers your question. The very first Bitcoin that were created, where you got 50 Bitcoin for mining a block.
Yes, and someone asked, is this called mining? This is what mining is. Mining is connecting computers to the Bitcoin network and trying to process transactions, trying to process blocks, and in so doing, get a block reward that is denoted in Bitcoin. Now, keep in mind, when they started doing this, they had to have an amazing amount of faith that at some point Bitcoin would be worth something. And they were probably pretty excited when Bitcoin was worth $1, right? Keep that in mind. They were probably extremely excited. Most of them probably sold when Bitcoin got to like $2. So the faith they had to have to continue to connect computers and mine it, and then to start sending it to each other. And then, of course, there's a famous Bitcoin pizza day when someone paid, was it 15,000 Bitcoin for a pizza?
10,000.
10,000 Bitcoin for a pizza, which we don't even want to calculate what that would be worth right now. But that is what happened.
No, so, Freddie, one question. Adam, there's a question we need to answer that was sent earlier.
Okay.
And it says, why is crypto mining a good thing? How can you compute and create a Bitcoin out of thin air, now worth essentially 50,000 a coin? That seems like a big time scam. I really don't understand why smart Wall Street people are on board with this. So to answer the question on why is crypto mining a good thing, crypto mining essentially makes the network secure. because all of these people and all of these computers are mining Bitcoin, that makes it secure to where if one of them falls out there, you would have to essentially hack 600,000 computers to change the Bitcoin. It would be cheaper to mine Bitcoin than it would be to try to hack the Bitcoin network.
Right. Okay. So what Ron is saying is because all these miners are connected, the goal and the forethought was, we hope this is valuable someday. If it's valuable someday, more and more people are going to connect their computers, right? There's going to be more and more what are called miners, and miners are just computers that run the Bitcoin code and try to process. So more and more miners are connected, and they all have to achieve this consensus. They all check off on the fact that every block was valid according to the code. You would have to get over 51% of these to roll back and change a transaction a few blocks earlier in order to change any of the code, any of the blocks that happened previously. So the more miners you have connected, the safer the network is. Okay, the more miners that are connected, the safer the network. Because, as Ron said, the amount of processing power and time and electricity it would take to try to get over 51% of this network and roll transactions back, you would be better off actually taking that electricity and processing power and just mining more Bitcoin. It would be better. You'd make more money at that.
Michael, to answer your question, it's always random. That's on the who wins. To answer the question on, there's only 21 million Bitcoin that'll ever be mined. Once that they're done mining, there's a transaction fee that will go to the miners that in theory will equal the Bitcoin.
Right. So real quick. So every one of these transactions has a tiny little fee attached to it. And the tiny little fee, when I send Ron 1 Bitcoin, goes to whichever miner mined that block. So the beauty of it is, okay, so this goes into halving and some of the value. Okay, so there will only ever be 21 million Bitcoin ever created. That is part of the code. That can't be changed. And the way that is enacted is we have what's called halvings. So we started off with 50 Bitcoin being the block reward. Then after about 4 years, we dropped it to 25 to 12.5, and where we currently sit at 6.25. Just last May, it changed to 6.25 Bitcoin for every block. And a block is mined about every 10 minutes. Okay, if they start getting mined faster than that, then the code switches to require more leading zeros before that block can be mined. This code is relatively smart, and they thought about a lot of these things. Okay, so again, what happens is all these miners have to connect, and they have to pay. This is called proof of work. And the work is they connect to the internet, they have to connect to electricity. This uses a tremendous amount of electricity. That's the biggest cost here to be able to do this. So they have to prove that they did the work. They have to have some sort of investment to create Bitcoin. And the reward is they get whatever this block reward, which is currently 6.25 Bitcoin for every block, plus whatever transaction fees come out of the block. That's what the miners receive. Again, they had to have a great deal of faith that this would have value. Now, the question is, why does it even have value? Okay, why is this even important? Why are we even talking about this? And the reason it has value, quite honestly, is because we decided it has value. Because eventually people started trading dollars for this, saying, I'm going to invest, I want to hold some Bitcoin. And the reason they want to hold it is specifically because of this $21 million number, or 21 million number. Because if there are only ever 21 million of them, and we can verify it because we can look at the code and we can look at the blockchain and we can know exactly where all those Bitcoin are at any one time. And we can know that your Bitcoin is a real Bitcoin. We can know all that. Then it functions as a store of value. It functions as something I want to hold because it has a limited supply. And others in the past have decided this is a place I want to keep my money because there's a limited supply, because it's verifiable, because someone else will accept that it's worth something. And therefore, this is where I'm going to put my money. And since more and more people have started doing that over the years, it has attained this level of value. And once it got to a certain tipping point, a certain point where enough people said, if I feel like there's going to be inflation, if I feel like there is going to be more dollars printed versus a fixed supply of Bitcoin, I would rather own the Bitcoin for right now, because if fixed supply Bitcoin, more dollars being printed, then logically the value of Bitcoin should go up. Again, we're not saying that it will. That is the argument. That is the investment thesis that a lot of these people have. Now, originally Bitcoin was created also as a medium of exchange. So it was also created to move money back and forth, again, in this frictionless way. However, the fact that it's worth $56,000, $57,000 right now makes it very hard for you to necessarily transact with someone really quickly and really easily for smaller amounts. Couple that with the 10-minute block time, couple that with the fact that not as many people have it, and it's not as good as a medium of exchange as they would have hoped, but it has become this store of value. Now, something else to keep in mind that I don't know, not everyone knows, but a Bitcoin, you can buy Bitcoin as far as 8 decimal places down. Okay, so you can get all the way down, let's see, 1, 2, 3, 4, 5, 6, 7, 8. That's 8 decimal places. That's how small of a portion of a Bitcoin you can buy. This is what we call a sat, or a Satoshi, is one, whatever this is, 8 decimal places of a Bitcoin. So hopefully that kind of gets us to where we are right now in terms of how Bitcoin is created and where it comes from. Now, a really quick other thing, because as we talk about advisors, financial advisors being able to help clients with Bitcoin, real quickly, what we have to talk about is something called a wallet. And a wallet is just another piece of software that I use to essentially hold the Bitcoin. And the important thing here is I have something called a private key and a public key. And I have a private key, and my private key gives me the ability to interact with this piece of software and send my Bitcoin somewhere. This is really important. My private key can also be used to generate millions of different public keys. Okay, that's the important thing. Private key can generate millions of public keys, but you cannot figure out what my private key is based on my public key. This is important because this is how we hold Bitcoin. This is what's called custody. We think of custody in the traditional financial world as Schwab or Fidelity or TD Ameritrade or something. This is custody in the crypto world. It is a wallet. It is software that holds the Bitcoin. I can give everyone in here my public key, my public address, and you can send me Bitcoin, but none of you can figure out my private key. My private key gives me the ability to transact, which really is what gives value, really what gives the value to my wallet and to my ability to move this Bitcoin and use it and send it elsewhere. And that is really important when it comes to safety and security. So a lot of what we talk about when we help advisors understand and we help investors understand is, how are we going to keep this safe? Where are we going to hold your Bitcoin or your cryptocurrency? How do we keep it safe, secure? What sort of insurance is there? All of those things. How do we keep your private key safe? This is a lot of what we talk about. So with all that, now what kind of questions do we have? Because I'm guessing there are a few.
Real quick on the last Bitcoin probably won't be mine till 2240 something. So there'll be a long time they'll still be receiving Bitcoin rewards. As far as the question on, there's a question out in the, let's see, Marco asked, this is what has always confused me about Bitcoin. Is it a currency with implied stability and transactability, or is it an investment with implied intrinsic value for something underlying?
Okay, so it's kind of like a lot of things. It has value. A lot of things have value because we say they have value, right? They have value to someone else. And Bitcoin lately, the investment theses have been around the fact that it is a store of value. So when last year, Paul Tudor Jones said, I'm going to put 1 to 2% of my fund, of my hedge fund, into Bitcoin because I see inflation coming down the road and I want to hold on to something that has a set supply. That is the store of value. That's that inflation argument. And once he did that, others started doing the same, saying, look, we can either go into gold, right, which traditionally has been the store of value of choice. We could go into the dollar, but if the US is printing the dollar, printing trillions of them, why are we going to go into the dollar? That's the thing that's going to be inflated. We could go into gold, and several of these hedge fund managers and now corporations have said, no, we're going to go into Bitcoin because it's just easier. It's easier to hold Bitcoin than it is to hold gold. It's easier to send it. It's easier to do other things with it. And it's easier, it's more transparent. We can see it on a balance sheet easier. We can go look at the blockchain easier. It's easier to do this than it is to hold a bunch of gold. Okay, and we know exactly how much Bitcoin there is at any one time in the world. And therefore, that's why, some of the, again, hedge fund managers, some banks now are saying, we're okay with an allocation to Bitcoin because it is an inflation hedge. And as the US government, especially as COVID came around and the US government and governments around the world started printing more and more and more money, then these, especially the hedge fund guys and corporations said, look, we see inflation coming down the road. We want to use this to hedge inflation. We can't hold on to dollars because if we just hold on to dollars, they are not going to be worth as much in the future. We're not going to be able to pay our bills. Therefore, we need to hold on to something that has a fixed supply. We can choose between these two. We choose Bitcoin because it's easier to get in and out of. It is without a doubt the most liquid asset ever. It trades 365, 24/7 anywhere in the world. We're not telling anybody to do this. This is just a little bit of information so you understand a bit. So when you're talking to clients or you read things in the news or you see stories about it, you understand a little bit about where this is coming from. Now, there are companies that take this wallet part and have created their own custody solutions around it so that as an investor, I can feel more comfortable with the custody of my Bitcoin. I don't always have to worry about my private key. There are companies that have created custody so that financial advisors and financial institutions can feel comfortable. And they've created their own private insurance around this, right? They've created their own security methods around this. So there are companies that have created custody. Then, of course, there are funds that have been created around owning Bitcoin. There's one called GBTC. There's Bitwise Fund. And basically, they either own a bunch of Bitcoin or they own a bunch of other cryptocurrencies. And they've taken care of the custody. They've taken care of the wallets and the security so that investors can just invest in them and not have to worry about all that.
Yeah, Michael, I think everybody has the whole Bitcoin equals tulip bulbs conversation. And that's, I mean, there's really no, I guess it's just what you believe. And as far, Marco, as far as the holding, or excuse me, let's see which one, if everybody held one Bitcoin, would it crash? It would probably go up if nobody was selling it, because if somebody else wanted to buy one, then, and nobody was selling it, the price would keep going up until someone sold it.
So I want everyone to keep this in mind. We said it's not a very good not a very good medium of exchange. We think about this very much in terms of the US and in the developed world, right? Because we have the scenario I went through earlier with my giving Ron a check and all that. That's a scenario that we feel comfortable with and that we trust really well, because we trust our banks and we trust our government. As much as we can moan and complain about them, we trust them. I trust that if I put $100 in the bank, it's going to be there tomorrow. But think about all the people in the world who can't trust that. They can't trust their bank and they can't trust their government. Their government might print trillions of dollars tomorrow just to pay off their own debt, just for fun. And all of a sudden they're Argentina and they have 80% inflation. Or they're, what's the country in Africa that has $1 trillion bills or something? Okay, they have that situation. They have this situation where the bank literally steals their money, or the government tells the bank, you can't allow anyone to come get more than $100 out of the bank today. So we think of it in terms of what we're comfortable with here in the developed world, but in so much of the world, they can't trust their government or banks at all. And they are trusting Bitcoin and they are trusting cryptocurrency. The two fastest growing areas for Bitcoin are Africa and India. And it's because of a lack of trust of the banking system and a lack of trust of the government. And so cryptocurrency and Bitcoin is actually being used to send money back and forth overseas, to send it to South America. People in Argentina are holding cryptocurrency like crazy because they have 80% inflation.
So Cody, to answer your question on how will it be inherited, and let me be clear that like 20% of all Bitcoin have already been lost, either for people losing their keys or dying and not giving their keys to someone. So I think it's 3.6 million are already gone and will never be back. So I guess in theory, there's only 18 million ever going to be out there. And the inherited part, you have to have a good estate plan and tell somebody where your keys are or where you're storing any of your digital assets. If you don't, then you're going to lose it. It's going to be gone. Freddie, did you get the link that I put in there about the wallets? So remember, some of those wallets might be exchanges that are holding like Coinbase wallet or a Huobi wallet or a Binance wallet. So it's going to look like there's only a few wallets that are holding a large amount of Bitcoin, but they're holding it for the clients that trade on their exchange or on their platform.
Yeah, and Ryan, thanks for sending that that link you just sent. Ron, real quick, I need to address some of these questions that were sent ahead of time. Is there an effective way for RIAs to invest in Bitcoin? RIAs can, if you want to go the AUM route and keep it in your AUM, the easiest thing to do to get exposure is something called GBTC, which is the Grayscale Bitcoin Trust. And Grayscale is a company that's basically created this trust or this fund that says you can go, or your clients can go invest in Bitcoin or in the trust, and the trust will then go buy Bitcoin. Okay, but your clients aren't actually buying Bitcoin, they're buying interest in the trust, which then hopes to buy enough Bitcoin to satisfy whatever the demand is. So they're not buying exactly Bitcoin, they're just buying exposure to the valuation changes of Bitcoin. Okay, and there's a pretty high premium sometimes on GBTC, and there's a pretty high fee, but it can be traded in most custodians. Most custodians will allow GBTC, so you can trade it in IRA, you can have it in a regular brokerage account. GBTC does have an accredited investor version, which has lower fees, but there's still the premium there. So that's kind of the easiest way to trade in Bitcoin. Another way that we've seen people do it is you can actually invest. Some of the mining companies are actually public companies. And of course, a few of them are here in Texas. There's one called Riot Blockchain, and there's some others that are actually just the Bitcoin mining companies. And of course, their value tends to go up and down with the value of Bitcoin. Other than that, as an RIA, if you can have project fees, if you can charge for doing certain projects or charge an hourly fee or something, you can help clients buy and sell Bitcoin. You can help clients buy Bitcoin, hold it, help create an estate plan and all that, and just charge them a fee. And that's what we've seen happen quite a bit is you'll charge $250 or $500 to clients to help them if they want to purchase, or if they've already purchased, to help them store it safely, to help them with an estate plan, to help them keep track of it. Okay.
As far as the question on advice for clients who ask about cryptocurrency as a way to catch up on savings because their coworker or friend said it was great. I mean, that's really from a planner's perspective, if it fits that client or not. I don't know. I mean, we don't know if it's going to go up or down. I guess if they bought it last year, then their friend made a good choice. If they bought it yesterday, maybe not, So that's a tough question. I think that's really per client.
Any recommended books or reading to help understand this topic further? There are lots of, there's a guy named Chris Berniski has a great book about Bitcoin. There's a guy named Andy Edstrom who has a book about investing in Bitcoin, and he's actually a CFP, a financial advisor, has his own RIA. And we can make sure that you all get some of the links to some of the books that we've read about Bitcoin, and Bitcoin has given us other cryptocurrencies and decentralized finance. We are here now to just talk, very, very, very briefly about Bitcoin. There's a question about taxes. Taxes related to Bitcoin and cryptocurrency is considered property. So just like anything else, you buy it for you put in $100 and you sell it for 200, you have the $100 capital gain, whether it's short-term or long-term. Now, the difference with Bitcoin and cryptocurrency and stocks, for instance, is if you buy it for 100 and it goes down to 50, you can sell it and buy it right back at 50. There's no wash sale rule. You can sell it, harvest this loss, buy it back at 50, and then maybe you watch it run up for long enough to get the long-term capital gains tax portion. Okay, so you can actually just sell it and buy it right back. So that's something else you can do. And as far as reporting, if you buy Bitcoin on an exchange like a Coinbase or Gemini or Cash App or something like that, they will report. You'll get a 1099. They will report to the government. So you can't use Bitcoin or cryptocurrency to hide money or hide taxes. Let's see. There's a question about the eventual winner between ETH, ADA, and DOT. Yeah, we're sorry. We're not going to give that kind of advice or thought. Those are different cryptocurrencies, and they're kind of competing with each other. And that's kind of an offline topic because that's way technical. How much risk? The risk, how much is a relative term, right? You have volatility risk when it comes to cryptocurrency, and you also have the technical risk, right? The risk of being able to hold on to your private keys, the risk of where the Bitcoin is kept. And then of course you have the volatility risk. You have the idea that maybe at some point it could go way down in value, just like you would with any other type of investment. Okay, so you as the advisor, and this is why we talk to advisors, is you have to help understand the risks, understand the risk profile of your clients, and figure out if it makes sense for them and if it makes sense for you. Okay, what other questions am I missing? Is Bitwise well, we're not going to, we can't really comment on whether BITW is a better solution. We'll tell you that BITW has a much higher premium than GBTC right now. Someone asked about another fund. Sure. Please address government regulation. Government regulation keeps changing. It depends on who's in power. They will tell you right now, they're
Hey, Adam, I just posted the link for everybody to fill out in the chat.
Okay.
You can fill out that for your CE credits.
Yeah, please go fill that out, and we will process for the CE credits. I
know some of y'all have to go. We can we'll stay here and answer your questions for as long as you need us to. Well, within reason, I guess. But I know some of you are ready to go, but we're just trying to get to your questions and knock them out first.
Why don't we give you guys is another 10 minutes okay?
Sure. Whoever wants to stay, but the link, Ron sent the link for the Google form so that we can use that to process your continuing education. So if you got to go, just make sure you get that link and go fill that out. Otherwise, we'll last another 10 minutes with you if you want to answer some questions. And if it's okay, Ron, let me go to the questions we got in advance first. Okay. Okay. How will blockchain facilitate information security? So that's interesting, kind of an interesting question. Well, it's a very interesting question. So so what Bitcoin gave us in terms of blockchain technology is being used in several different aspects. So you have this blockchain tech, which is just a chain of data that can only move forward and can't move back. And once we realize that, okay, all these, it's an incentive mechanism, right? All these computers will actually connect to a network and process transactions. And the incentive they need is some sort of electronic or digital currency. Then we were able to go farther with it. Then very talented programmers said, we can not only move money or move funds back and forth using this, now we can move data. Now we can run computer code. We can run programs called smart contracts. And so what we're seeing is the ability to create identity solutions utilizing blockchain technology and the ability to use these cryptographic data to ensure more security. And something we do have to address, which I didn't address in here, is the idea of security, because we hear horror stories about hacks and such. And to make it perfectly clear, the Bitcoin network itself, the code, has never been hacked. Bitcoin has not been hacked ever. Exchanges that allow you to buy and sell or trade Bitcoin or trade cryptocurrency have been hacked. It is no different than, Target being hacked or a credit card being hacked or something. It is like that. So the weak point of a lot of cryptocurrency is us, the users. It's, does someone get my private key? Is someone able to get my username and password for a particular exchange? Those are the weak points, and those have been hacked in the past. But the actual Bitcoin code has actually not been hacked, and a lot of that is able to now be used for other security and identity solutions going forward. Why is crypto mining a good thing? I don't know if it's a good thing or a bad thing, but what we did was we basically said we see all these issues in the economy, in the world economy and in the financial system that banks and governments have put on top of us. And they're causing all these extra fees, and they're causing essentially inefficiencies in the world economy. And how can we make those more efficient? How can we allow those in other countries, especially, to have more participation in the world economy? And the way we can do that is take out some of those fees and some of that friction. And we utilize cryptocurrency to do that. We utilize this electronic money to be able to do that. But in order for people to help us create that electric money to move those transactions forward, we have to make them do something. They have to invest something. And what they invest is in the computers, in the miners that actually process the transactions, and they invest in electricity. That's what they have to invest. And that's why we say it's proof of work. You have to invest to be able to do that. But if you're going to make the investment, then we will give you some sort of reward. And in the past, hopefully that reward would eventually be worth something. And now what we found is enough people have decided that that reward called Bitcoin is worth something. And they're going to, and they have kept purchasing it and kept making the value go up and up and up. Whether it continues to go up, I don't know, because that's going to be determined by, how all these people that are buying Bitcoin or selling Bitcoin, what the value they see in it. If someone comes out with something better, then maybe Bitcoin will lose value. I'm not quite sure what's going to happen. We're really just here to tell you how it works. Okay, what everyday value and application does Bitcoin have? Okay, we talked a little bit about this. If anyone starts accepting Bitcoin as payment. And Tesla announced last week or so that they're going to start accepting Bitcoin to pay for Teslas. Look, Bitcoin is probably not going to be utilized as a medium of exchange, but what Bitcoin and the code and decentralized finance has given us, because of that, because people wanted to use it as a medium of exchange, but it was too volatile, is through DeFi, they gave us something called stable coins. And this is not for the topic here, but stable coins are essentially a cryptocurrency that is worth relatively $1. And they've either used algorithmic methods, or they've used methods where a company will literally hold billions and billions of dollars in the bank and issue a digital coin, a digital token for every dollar that they hold, so that they can be transacted easier, so that they don't have to go through banks anymore. We can use them on this digital ecosystem. And that's where stable coins have come out, because Bitcoin is too volatile to use as a medium of exchange. So we've created something called stable coins. And if we get really technical, they're usually on another blockchain called Ethereum, which is a totally different code. But that's what we've seen come out, is we want to have something that's worth relatively $1, because we can't rely on the value of Bitcoin. Because by the time I send it to you, it might have gone up in value a few percent. And that is a problem. That's a problem for Amazon and Walmart and Starbucks and whomever. So the proverbial cup of coffee Bitcoin is not going to happen. But I have something in my crypto wallet called USDC, which is US dollar coin, which I can use to actually pay for things. Apple Pay will let me do that now. Several credit cards will let me do that. MasterCard and Visa are starting to allow that. And that came from the technology that is Bitcoin. A lot of providers to register with. Do you feel, there are different ways to go in terms of holding Bitcoin, buying Bitcoin and holding it. They're all different ways to go. And for you as an investor, or you as an advisor, it's a matter of what you feel comfortable with and what other fees you're willing to pay to someone else to potentially hold on to your Bitcoin and keep it safe. So if you wanted to invest, $500 or $1,000 and you don't see that as very much money, then you might keep your Bitcoin on an exchange where you can access it relatively quickly. You can get it back into your bank account if you need to, something like that. If you're going to invest 6 figures, 7 figures in Bitcoin, you're going to go into more in-depth security in companies that have better custodial solutions and better security and better things that have better ways to transfer it to the next generation and such. Okay, any other questions from the chat here that I'm missing?
I've been trying to answer as many of them as possible.
Okay, thank you.
Neil, to address the situation on the federal government shutting it down, if it becomes a threat to the U.S. dollar, in theory, what they could do is not allow U.S. people to change it into dollars. But as far as shutting down the actual network, they really have no control. I guess they could say you can't mine it, but then it would just push it all overseas. Where one thing that Adam didn't mention, blockchain technology and cryptocurrency in Europe, Asia, Africa is way far ahead of the U.S. Way far, as far as adoption and use and everything.
Right. So the U.S. government, any government, can shut down crypto. They can say you can't transact in it, you can't hold it. Okay. And India has tried to do that. Nigeria has done that recently. But basically, what they say is you can't go from your bank account to buying Bitcoin. We're not going to let the banks do that, and therefore you can't take your dollars or whatever other currency they have and exchange it for Bitcoin. But they can't stop the Bitcoin network from going. Those people will just have to figure out a way to, there are gray markets in Africa for Bitcoin. So, and look, this is a lot of information that we've given you in a very short amount of time. And I will, if it's okay, make a quick shameless plug. We actually have a course, a certification that we created for financial advisors to learn about Bitcoin and crypto in a way that you can actually adapt it and make it part of your practice. So we talk about security and safety and who the custodians are and conversations to have with clients and investment theses. And we go beyond Bitcoin into other cryptocurrencies. We explain it. We explain wallets and everything else, all these questions. We actually have a certification. The website, Ron will put on here, certifieddigital.org. And we will actually give you all a discount code that if you want to do it, it's 50% off our core. We do it as a cohort base. So it's on-demand videos. And then every week we do a 2-hour live session where we answer questions and we walk through conversations and news that happened that week. So Ron, if you'll go ahead and put our link in there for the course, and the discount code is FPAHTX50 for 50% off.
Also, there's a free course, a free mini course. And I think it's at Interaxis, correct, Adam?
Yes.
I'll put that in here as well.
Okay, thanks. Okay, did we kind of get all this? And we can give you our email addresses as well, so that if people have other questions outside of this, we're happy to chat about it. We love talking about this all day. Discount code, sorry, FPAHTX 50. There we go. I think, Margarita, are we up on time?
Yes, she told me to make you.
Oh, she told you to tell me that we're out of time. Okay. I know that was a lot of information. I appreciate everyone for coming. This was great. We love talking about this. You all, they will send out all of our information so that you can get back to us if you have more questions, schedule appointments, what have you. We're right here in Houston, so it makes it really easy to come talk to everyone. And thank you very much.
Thank you. Thank you, Ron. And I hope that we'll be maybe doing some more series later on, do a 201 series on cryptocurrencies going in the future.
Oh, well, I hope so.
Yes. So thank you all for joining in, and hopefully everybody got their CE credit link and the link to enroll. If you have any questions, please send it our way. Thank you.